Hello, Haseeb. Welcome to the 100X show.
Hey, man, you good to be here.
Just a disclaimer, you're the first investor and a thought leader when it comes to crypto space on the 100X. Usually, we go for founders in project. I'm a fan of your writing, and I follow Dragonfly's portfolio. You were one of the figures that I wanted to get on the podcast.
Well, I'm honored to be here. Thanks for inviting me.
Yeah. So Haseeb, just to kick things off, tell the audience about your background and your journey towards crypto, and maybe also touch base with what you guys are doing at Dragonfly Capital.
Yeah. So, very briefly, because I have a pretty long and winding story, but the TLDR is that long time ago, I used to be a professional poker player. I did that for 5 years when I was 16 years old until I turned 21. I was ranked one of the top online Hold'em players in the world when I was 19. Eventually decided that I wanted to get into the tech industry, move on from poker. I came out to Silicon Valley, learned how to code, and I became a software engineer. I was working at Airbnb when I first caught the crypto bug. I got my start doing some security research against one of the very first DeFi protocols on Ethereum called Bancor. Me and a buddy of mine, we discovered a front-running vulnerability in Bancor back in 2017. And we published it. It's kind of how we first made a name for ourselves. I then went to 21, which became earn.com, which got acquired by Coinbase. Then I was working on my own startup building a stablecoin when I ended up getting recruited by Naval, who is the founder of Metastable Capital, which is one of the very first and oldest funds in crypto. And he ended up recruiting me to come on the investing side. And that's how I got my start as an investor. And so I was at Metastable for a little while through the bear market and the 2018 crash. And then I ended up partnering up with my now partner, Bo, to build out what today is Dragonfly. So I've been one of the managing partners at Dragonfly now for a little while now, since 2019. And we're a global crypto fund. We've been very early investors into a ton of stuff that's been generation defining in DeFi. So, we're early in MakerDAO, Compound, UIDX, UMA, 1inch, Ribbon. We're early investors in a lot of the layer ones and kind of core technology. So we're early investors into Avalanche, Near Protocol. Actually, both of them, I actually invested in the seed round of Avalanche and Near Protocol back when I was at Metastable. And we continue to invest in my time at Dragonfly. We also did the seed round of Matter Labs, which is one of the leading ZK rollups. We've been early investors into a bunch of stuff in CeFi as well. So we were early investors into things like Anchorage. We were early investors into Bybit, which is one of the leading derivatives exchanges. We invested in 4 of the 5 unicorns that came out of Asia over the last several years. We've been very actively covering all the innovation happening in things like NFTs. We're investors. We led the seed round of Gem, which is the leading NFT aggregator. We've done a few deals in gaming as well. Overall, we're a very full stack firm. We're also a very global team, so we have folks all around the world. We take a very technology first approach to investing into this stuff, and we tend to back people in the earlier stages. So we love investing in the seed and Series A, but we write checks up to $30 million. So that's Dragonfly.
Yeah, let's explore that. So, as an investor, what's your process in terms of evaluating, let's say, seed stage project to all the way to Series A, B? What are some of the key variables you look for, and even before you start investing, like what's your thought process in terms of like macro thought process in terms of formation of thesis before you start deploying capital? So I would love to explore that.
Yeah. So when it comes to evaluating a seed stage company, so seed stage company is sort of the most, as we say, tabula rasa. I mean, it's sort of blank slate. Like there's not that much to actually evaluate yet, usually in a seed stage company. And so a seed stage company is much more about the team, about the quality of the people, and it's about the beginnings of an idea. Sometimes the idea isn't even fully fleshed out by the time that you're investing in a seed round. But usually seed rounds are pre-product, especially in crypto. And so you're more evaluating the market than you're evaluating the particulars of the product. So the question is, are you guys moving in the direction of something that I think where there's value there? And you're thinking about it, you've done your research, and even if you don't necessarily have an innovation per se, meaning that the thing you're trying to do has been tried before, the question is, do you have some unique insight or some unique tactic or some unique angle on trying to solve this problem that no one else has solved before, right? So let's say you're trying to build like an NFT rental platform. It's like, okay, there are people who have tried NFT rental platforms in the past. It's kind of an area that a lot of people are thinking about right now. What insight do you have that will allow you to take a different angle on solving this problem than the people who've come before you and the products that are currently live in this market? If you don't have an answer to that, then generally, that's something I'm going to mark against you in a seed round. But you don't need to have the product figured out. You don't need to have all the details figured out. You don't need to have, all these other things. And the other thing that I think is especially important when you're investing in seed is that you don't want to try to invest for lack of weakness. You want to invest for strength. So almost always the very, very best teams in crypto have some kind of weakness. There's something that you notice that this is a very obvious problem with the startup that you're building. That's okay. The thing that you really need is that you need to be 10x at something. You need to be really, really strong at something. If you don't have that, if you're like okay in a lot of different dimensions, that is usually the sign of what is a mediocre investment. Almost all of the really great investments have some kind of outsized advantage somewhere that ends up in the long run, converting into a real wedge that allows them to build a strong place in the market. Now,
Yeah,
go ahead.
let's do an example. So you told our audience that you were early investor in Avalanche and here. By the way, both protocols we are very bullish on at Token Metrics. So let's say moving back a couple of years, when they pitched you the ideas, what were some of the things that stood out? Okay, you knew that okay, they like something is clicking here and they would be able to execute.
Yeah. So Imin Gunsir, who's the creator of Avalanche, so I know him as an academic and as a researcher. And so when he was initially came up with the idea of Avalanche, and I remember we sat down with him at a coffee shop in San Francisco, and the pitch at that time, there was nothing about smart contracts at that time. There was nothing about Ethereum or the C chain or any of that. It was way too early for any of that stuff, right? The idea at that time was that we developed a new consensus protocol, and what we're going to do is we're going to launch the idea of subnets was a thing at that time. And the idea is that we're going to launch all these subnets that are going to be connected through some beacon chain, and those subnets are going to each copy the VMs of other popular blockchains like Bitcoin and Zcash. And, we're going to run like an Avalanche Bitcoin, Avalanche Zcash, Avalanche Monero. That was the idea. And I thought that okay, that is crazy. That's awesome. I love seeing somebody who's going to take a shot at something really big and aggressive. And again, to be clear, that is not what they built, right? What they built was primarily the C chain, right? The C chain is the big popular thing on Avalanche, which is the EVM sort of Ethereum clone that runs on Avalanche consensus. But at the time, all they had was a half-baked go-to-market about how they're going to copy other VMs, and the consensus mechanism and the vision that look, we want to build the best blockchain. And just knowing what I know about Goon, how aggressive he is, how strong of a marketer he is, how strong of a following he has. Part of what you need in order for a layer one to be successful is you need a great leader. You need that sort of somebody who's going to catalyze users in a marketplace and really kind of start more than just a technological movement, but also start a religious movement. And immediately you could see that in Goon is that it's sort of the pundit in him was going to be very, very effective at building a strong community around Avalanche. So that's what compelled me to do the seed round, and then we also invested in the Series A and again in their sort of Series B, quote unquote, after that in my time at Dragonfly. So that was what I originally saw in Avalanche. In Near Protocol was a very different story. So Near Protocol, so these guys actually originally, before they were building a blockchain, originally it was actually an AI company. It was called Near.ai, and they ended up changing the name to Near Blockchain. And Near.ai, they basically, they'd gotten some funding, I think from Amplify to build some AI thing. I don't even remember what it was. But it didn't work. And so they ended up pivoting into blockchain because their view was that, everybody who's working in blockchain, was so dumb that it was the EVM was a piece of crap. Ethereum had no idea how to scale. Nobody really understood distributed systems. These guys, they worked at Google and MSQL. They built all these super huge production databases, and they were just look, this is not as hard as you guys think it is. There's just no good engineers in in this world. So we're going to come in and we're going to design a much better protocol to build a better blockchain. So I remember, me and Yvonne, who at the time he was with me at Metastable, he's now at Dragonfly. He and I sat down together with the Near team when they pitched us on their design for. At that time, it was not what it is today, which is like, okay, sharded blockchain, blah blah blah. The thing at that time was that we're going to create a blockchain that can run on mobile phones. That was the idea for Near at that time, is that it's going to be so compact and so efficient that you're going to run it on a mobile phone. You're going to run a full node on a mobile phone. And so I remember we sat down with them and they had like this piece of paper in this cafe that we were meeting. This was back in the pre-COVID days, so everyone was doing their pitch meetings in cafes. And they had written out, they kind of described for us this protocol about like how it's all going to work in mobile phones and all these whatever, Merkle tree, whatever, something. And basically, I essentially ripped apart the entire protocol. Nothing about what they described was going to work. I sort of showed them all these big failures. I don't remember the details, but it was there were just a bunch of really bad assumptions they made about I/O and about networking and about how much state there was going to be compacted in this thing and how efficiently it could actually run in mobile phones. And I was so like, yeah, none of this stuff works. Your design is totally broken. And they were like, oh shit. And they were like, okay, we're gonna change it. We're gonna fix it. And then they came back like a week later with a totally different design. And they're like, no, this design is really going to work. And the thing that ended up impressing us about Near was not actually the specifics of the design. Like we told them, like, look, you should drop this mobile phone thing. Like nobody cares about running full nodes on mobile phones. This is the wrong problem to try to solve. But what I like about you guys is that you guys are super scrappy. You're super sharp. You're very, very fast. And you're really, really good engineers. And I can tell that. I can tell that you guys can very quickly turn out an entirely newly formed design in a very short period of time and really think through some of the problems that we presented to you guys. Normally when you get a team that pitches you some protocol design and you rip it apart, they're like, oh shit. Well, okay, now I'm, now I got to start over, or like, I don't really know what to do with this. Or you make some small tweaks hoping that you're going to fix it. But these guys completely rewrote the protocol within a week, or, respecified the protocol. And the feeling that we got was like, look, there are a lot of kind of professorial academic approaches to try to build blockchains, and Avalanche was very much that, right? Like Emin Gün Sirer is a very famous professor at Cornell. But I've never seen a blockchain just be built by just raw engineering talent. And the bet was kind of like, okay, what would happen if you got, because everybody who's in the founding team of Near, not only were they very experienced developers, they were all ICPC and IMO programming competition champions. They were very, very, very good programmers. And nobody who had built a blockchain before was like that. Everybody else who built a blockchain was either very academic or they were kind of like these these sort of cypherpunk crypto native types. And we were like, okay, what would happen if you just put just raw, absolutely monstrous engineering talent from some of the top places in the world, with Google and MemSQL and all these different places, and you got them to try to build a blockchain? What would happen? That was the bet on Near. And eventually, and it turned out, the idea that these guys are going to turn out a new design, well, they did it again and again until they finally arrived at the sharding design, which is the design they have today, which is basically what, often called, ETH 2.0, but actually delivered. And it turns out that, like, again, part of what makes Near so strong, again, it's the same thing that they started with, which is that they're just really freaking good at execution. They're really good at actually building really solid and robust tech that works, that scales, getting a great developer experience because they understand developers really well, and just getting all that stuff out the door and not saying, oh, we're gonna build this, we're gonna build that, actually shipping it, launching it, and getting it into production. And that's what's been the superpower of Near. That's the thing that they're 10x on.
That's awesome. Now shifting gears a little bit, how do you evaluate, let's say, Series A to, let's say, Series C? Like, what are the different ingredients you look for apart from the team?
Yeah. So, team is always the synchronon, right? You always need team to be solid. But as you're going further upstream, or I should say further downstream, you need to see more signs of traction, right? So now it's less about the team and it's more about the product. It's more about the metrics. It's more about the adoption. So what do you want to see at a Series A company? Series A company means that ideally you want to do a Series A once there's product market fit. Usually in crypto, that's not the case though. Usually in crypto, Series A doesn't mean anything. Doesn't mean there's a product market fit. Sometimes Series A's are still pre-product. So Series A's can oftentimes be continuations of seed in terms of the way that you evaluate them. In traditional companies, usually Series A is what happens, after product market fit, or at least the first signs of product market fit, or at least the product is done and now it's like pretty much ready to prove whether or not there's product market fit. In crypto, it kind of runs the gamut, right? So if you're investing into an equity company, then a traditional company, then usually you're starting to see some signs of traction, some signs of early growth, some signs of product market fit. In the protocol world, generally speaking, it depends. Oftentimes, Series A's are done in pre-product. So the real inflection point is not whether it's a Series A or the Series B, but the question is the product done? And is the product live and in production? And can we now see the metrics? So if you can see the metrics, then really what you want to see is you want to see growth. And you want to see growth happening on a month-over-month basis. And you want to see a clear plan from the team about how they're going to lean into this growth. At a Series A or even a Series B, you don't need to really worry that much about monetization. You don't need to worry much about protocol value capture. I mean, you need to think about it in the abstract of like, okay, if this thing is successful, can it even capture value? Generally, at the seed stage, you don't need to worry that much at all about value capture. It's kind of too early to be thinking about value capture. By Series A, you need to have some answer for if this thing is successful, how is it going to capture value? But you don't need to have it being capturing value at this moment in time. That's not necessary. And once you get to Series B, Series C, and you get into Series D or even later stages, that's when you need to start thinking about, okay, how am I going to exit? In token land, it's pretty straightforward, right? In token land, okay, you get tokens and you sell the tokens. But when you get to Series C, Series D in traditional equity investments, then you need to start thinking about, okay, is this thing going to IPO? Is this thing going to get acquired? Does this thing really have a path to liquidity? And those questions get more complicated as you move into less regulated parts of the crypto industry, right? So if you're investing in Coinbase, it's very easy. Coinbase can IPO. If you're investing in a Gemini, okay, Gemini can IPO. But if you invest into more far afield companies, especially when you go outside of the US, then the path to IPO becomes a little bit more murky. And you have to start answering tougher questions about how this thing can actually get liquidity in the overall lifetime of the investment. So that's some of the considerations as you're looking further afield into some of these companies.
So for example, if a protocol or a company ticks all the boxes, but the valuation is too high on both the ends, let's say on seed as well as Series A, Series B, like is that something that can also be kind of like a turnoff? Like, okay, like the valuation is too high, the ROI doesn't make sense, or the exit opportunity won't make sense. So is valuation also one component that you personally or professionally look at as one of the metrics, or maybe as a metrics that signals something about the founder or maybe the ability to execute?
Yeah, absolutely. I mean, there are valuation is the foundation of being able to make good investments, right? Because ultimately you make money by investing in things that are underpriced. And so, there's no such thing as a good investment. There's only a question of a good investment for what price. If I'm going to invest in like a really, really crappy company, but I'm going to invest at, $20 as a valuation, then okay, that's a great investment, right? That's a fantastic investment. And so the reality is that now there are certain things that are great investments almost no matter what the price, and everyone knows it. And this is because a lot of people understand, everybody involved knows that this thing is going to be huge, and everybody wants to get a piece of it, right? And so there are certain deals that are just not going to be priced at the right price because of the dynamics or because of the moment or because of whatever. But the investors involved know that this thing is going to be successful. And, usually what that means is that these rounds are going to be extremely competitive and the biggest dog is going to win is usually the way that works, right? So one example of that was Compound. So we did the Compound Series A, and that deal was led by Andreessen. Everyone was trying to get into that round, right? It was because that was a time when Compound, this is before their token, before DeFi Summer, but Compound very quickly became, I think they very nearly exceeded MakerDAO as being the largest TVL protocol on Ethereum. And I think they ballooned from 20 something million or something to 130 million in the course of a couple months. And everyone knew holy shit, Compound is going vertical. Compound is going to be huge. And so everyone was fighting to get into that round. And that was one of those situations where you don't need to be smart. You don't need to see around a corner. You don't need to have some great vision about what's going to be successful. You just look at the metrics and you back the winner, right? That's one situation.
Yeah. Now, so this leads me to another question. So let's say if the deal is very hot, there are multiple high-tier VCs fighting for it. Firstly, how do you source them, and secondly, how do you close them? Like, how do you close that deal? Is it the marketing? Is it the brand? Is it the value add? Like, how does all of these variables come into the equation?
Yeah, the answer is everything. It's like asking, how do you get a, very attractive woman to like you? And the answer is like, is it your looks? Is it your personality? Is it your whatever? The answer is everything, right? You need the whole package. Otherwise, like, yeah, they're going to go with somebody else who's a better package than you are. So you need, generally speaking, the way that I think as an investor, the way that I think about it is that there's kind of there's two components to winning a deal. There's marketing, and then there's sales, right? It's kind of the same thing as a company. Where marketing is kind of one to many, right? It's like the speakerphone. It's the work you do up front before you show up in front of the customer. And then sales is like hand-to-hand combat. Sales is like you get on a call with the customer and you try to convince them to buy your product. Well, investors are the same thing. There's marketing, which is like the work you do up front. It's like, the research you publish, the Twitter spaces you do, the podcasts you do, the conversations that you have in public, the tweets, the value add, the events, like the parties, all that stuff that you do to build your brand as a firm, and just all the investments you've done in the past, which is like kind of the biggest marker of your branding as a firm. That's the work you do up front. That's the marketing. And then the sales is when you jump on a call with the entrepreneur and you try to convince them to take your money. That's the hand-to-hand combat. And usually, the work is done before you show up, right? The lion's share of whether or not you're going to win that deal has already been decided by the marketing stuff you did up front, right? If someone shows up to the supermarket and you're like, great, I'm going to try to convince them to buy RC Cola. It's like, no, you already lost, right? Like you already lost by the time that Coca-Cola was on TV and it was, on all the subways, and they did all the work up front to make it so that nobody who shows up in the store is going to buy RC Cola. They're all going to buy Coca-Cola. And in the same way, that is oftentimes true when you're looking at deals. Now, the exception to that is that if you really, really are great at selling yourself and doing the upfront work, and especially if you are small, that is the biggest thing that's going to be a wedge for you in being able to get into some of these rounds. Is that if you're a small investor, then it's a lot easier to be able to justify your costs in the round for your value add, right? In the same way, if you want to get someone to buy something in your store and you're like a new candy, well, it's a lot easier if you're like a 50-cent candy than if you're, going to be, $3 a bar. And the same thing is true in venture. So that's why oftentimes it's a lot easier for someone like an angel investor to start building their brand and getting into deals. Because if you're an angel investor, you say, look, I'm going to be able to introduce you to, this particular set of companies. It's like, okay, if I'm going to take a 100K check from you and you're going to, or a 50K check from you, and you're going to introduce me to these companies, that's great. But if you want a $5 million allocation in my round, you better do a lot more than that what that angel over there is doing. And so that's the other consideration that when you're a large fund like Dragonfly, you have to bring a lot more to the table than you would be if you're a smaller fund, taking smaller allocations, and concomitantly, you don't need as high a value add in order to win those deals.
Yeah, this makes sense. So let's say once you are invested in a great project, you're convinced that this is the project, then how do you think about exit? What are some of the, it's a generic question. So when do you exit? How do you think about that? How do you track execution? How do you build more conviction for later rounds? And also, how do you kind of tackle the issue of valuation? Because in crypto, sometimes, like even with Near, for example, there was a point where Aurora had higher valuation than Near. So all of these things, how do you kind of tackle them once you invested?
Yeah. So, well, the first thing to understand about valuation in crypto is that FTV is nonsense, right? So, fully diluted valuation, it stands for FTV stands for. Fully diluted valuation is not a meaningful number, although we'd like to pretend that it is. It's more of a sense of what a unit of this thing will be worth at a certain terminal valuation for the overall token supply. But the reality is that FTVs are just not reflective of what a thing is actually worth, because when the tokens actually do come out of the market, what you see is that the price generally goes down, right? It's fairly obvious. Unless the demand increases, when the supply increases, the overall price will go down. That's how economics works. So, and of course, these things mostly don't have fundamental values, right? Some of these things do. There are some things that have, an obvious PE ratio, and you can very easily quantify the total amount of value that's being generated by the protocol. But most of these things are reflexive, and they're a sense of perception of how valuable this thing is. So for that reason, I think FTV it's not very useful to look at FTVs. That's the first comment I'll make. Now, the question of how you exit positions. That's always a tough question. So if you're investing in equity, it kind of solves itself, right? Which is that you can't exit unless there's a secondary sale or unless there's a exit of some kind within the company itself, whether they go public or whether they get acquired, right? Those are your paths to exit. Now, if you are, on the other hand, for the token side, it's a lot more straightforward. Now, that being said, as early stage investors, generally speaking, we have lockups when we invest into a token. So even when the token goes live, we can't sell because we're locked up for 3 or 4 years from when the token actually goes live to when we have full liquidity on our position. Now, when and how we sell, it's kind of a matter of art more than science. It really depends on where the market is, what our perception is of the overall company / protocol, if we, kind of our confidence level on the overall position, and also just, if we want to control our own risk. Generally speaking, we want to remain long these things because we're bullish overall on crypto and on the different things that we've put into our portfolio. And we also want to be supporters of the protocol, which makes it, we don't want to be in that position where we're selling the tokens as soon as they unlock. But the answer is that, it ultimately depends on the particulars of the project, particulars of the liquidity profile, and particular of how well we think the protocol is doing and how long we want to be holding it. Eventually, we do have to sell everything because we are a venture fund and we have to return our capital to our LPs. But hopefully that is, that takes place over many years, not just, the moment that we unlock. We have no obligation to sell the moment that we unlock.
I think now is the time I want to map out some of the investments Dragonfly has done, and basically explore the thesis behind different verticals. So I'm going to share my screen for the audience here, and then basically we can take it from there. So I just wanted to explore some of the thesis, your thesis behind some of the investments you have done in the past, and even now. So let's start with infrastructure. Like, what's the 40,000 feet overview of the way you kind of seeing the crypto landscape next 3 to 5 years?
Next 3 to 5 years. So I think clearly one of the big stories in crypto today is around scaling. And right now, smart contracts aren't really scaling. We see that Ethereum and Binance Smart Chain have enormous amounts of demand, but that demand is not being sufficiently satisfied by the total amount of block space that's available. And once these blockchains get in high enough demand, they start to fall over. They don't have enough throughput to satisfy all the users who want to be using them, especially at peak, but even at equilibrium. The amount of people who want to use Ethereum is much larger than the total Ethereum block space. And so it's very clear that we need to scale all of this stuff. And there are a few different paths to scaling. One path to scaling is through rollups, which, we're early investors into Matter Labs, which is one of the dominant rollup ZK rollups in Ethereum today. We're also investors into a bunch of alternative layer ones. So we're investors into Near Protocol, Avalanche, Terra, Celo. So we've invested in quite a few of them, Mina as well. But there's also interoperability, right? So if you look at something like Axelar or Cosmos, these are approaches to being able to scale by connecting up multiple different blockchains together in an interoperability network. So Cosmos, of course, has these application-specific blockchains that can connect up together within, connecting to the Cosmos hub and communicating via IBC. And then Axelar is a completely agnostic cross-chain communication network that can connect to EVM chains as well as to Cosmos chains as well as to Bitcoin, and allows assets and cross-chain messages or cross-chain contract calls to be executed across any different sets of environments. So those are some of the investments that we've made on the infrastructure side, and I suspect that this is going to be the biggest story for the next 2 to 3 years. Is how do you make smart contracts scale to 10x or 100x where they are today? And part of this also flows into the piece that we published recently about blockchain scalability, in that even the blockchains that exist today are actually less scalable than they might initially appear at first blush.
Yeah, we will dive later in the show. We'll also dive into that. Like I read that piece and I enjoyed it. It was kind of eye opening as well. 100,000 TPS sometimes can just boil down to 600 TPS.
That's right.
Yeah.
That's right.
So apart from infrastructure, like, what's your thesis on DeFi? Like, how do you kind of see DeFi space evolving?
So the DeFi space, so it's right now. So we've been early investors in a lot of stuff in DeFi. So we've done Compound, MakerDAO, 1inch, UMA, Anchor, DYDX, Derivadex, Numerai, Ribbon Finance. We've been very active and aggressive investors into a bunch of stuff in DeFi. Now the overall picture that I have of DeFi is that right now, there's actually relatively few things that are working at scale in DeFi today. So, I mean, if you look at, most obviously speaking, right now you see that, spot trading is working through Uniswap. Then we have borrowing and lending through Compound and Aave. And then we have really, it's like on-chain yield. So you get yield aggregation, yield optimization, those seem to be working. But not that much else is really working in DeFi today. Even derivatives, which ostensibly are doing okay through DYDX, are still quite small relative to the overall spot market in DeFi, which is very strange because almost every market structure that we know of, you end up seeing that spot markets are actually spot markets tend to actually be bigger than what you see derivatives are bigger than what you see in spot. And today in DeFi, it's the opposite. Is that spot is bigger than derivatives. And so, my view is that this is going to change. I don't know when exactly it's going to change, and I think there are some pieces that need to get figured out in order for this change to become fully realized. But it will happen with time. And not only that, I think we're also going to see synthetic assets grow. So right now, synthetic assets are still quite small. There's not a ton of demand for them. But I think this is going to be one of the most vibrant parts of DeFi is people being able to get exposure to any financial asset they want to through synthetic exposures through derivatives rather than through
I agree.
spot markets.
So my exposure, the way I started into crypto was because of this. So in during the pandemic, I was in Pakistan. I finished my masters and I was in Pakistan, and I saw this opportunity in the markets, like especially the US market with Nasdaq and S&P, just in a free fall. And I was like, okay, the valuation makes sense. Let's pull the trigger. But the whole interactive broker process, like my application was accepted when the whole move was done, and then I saw. Then I saw DeFi summer, and then I saw some of the synthetic products out there, Mirror, synthetic that itself, and I thought, you know what, this is a very interesting space. So that was one experience that basically was an eye opener for me. That is the reason why I'm bullish on crypto, and I kind of feel like how it can impact a lot of people's life. It's truly global in that sense.
Yep.
All right. So let's explore your thesis in regards to NFT gaming. How are you kind of approaching that space? Are you trying to take index level exposure, or you're also willing to take concentrated bets, let's say on a particular game, for example?
Yeah. So on the NFT side, so we're broadly bullish on NFTs, although we tend to stay away from investing into particular NFT projects or NFT launches. I think NFTs seem to more and more, especially around PFPs and kind of the things that are popular today, they seem to resemble more and more kind of like luxury goods. And, it's kind of like, okay, this, is Bored Ape Yacht Club going to be the Gucci, and is this thing going to be the Prada, and is this thing going to be the whatever? And you can very clearly see also there are these very quick cycles of fashion where these things, become very, very popular, and then the floor prices drop, and then the next thing ends up coming along and becoming the next big thing. And so investing into an industry like that is very difficult to pick individual names and to be able to predict correctly which things are going to take off and which ones are not. It's much more effective, we believe, to invest in the infrastructure layer and to bet on things that we think are going to be long-term successful on the infrastructure side that are going to work regardless of what individual names or individual collections are going to be popular. And so that's why we've mostly been investing on the infrastructure layer on the NFT side. But we're broadly bullish that NFTs are going to grow and become more complex. And one of the recent investments we made in NFTs is actually into a company called Gem, where we led their seed round. And Gem is today the largest NFT aggregator. I think they do something north of 10% of OpenSea's volume is now coming through Gem, and a huge amount of professionalized NFT traders trade on Gem because they actually can trade with lower fees than they'd be trading on OpenSea directly by trading through Gem because of both affiliate rebates from OpenSea, as well as because of the gas optimizations that Gem makes. So there's a bunch of stuff, and the sort of infrastructure layer, I think, within NFTs, it's also quite compelling. That gets us really excited about what's coming soon. I'd say on the gaming side, there again, I'm a bit cautious on gaming. I feel like a lot of the gaming names that are out today are, I think, a bit overstretched. I think there's a lot of there's a lot of hype, and I think the execution so far in gaming has not been great. And so I'm not super bullish on the current generation of crypto gaming projects that are out there right now. But I do think that crypto gaming is going to be big. But I'm somewhat of a bear on the notion of play to earn. Or at least the notion of play to earn as it currently exists today, which is this idea that you create a game, there's some kind of monotonous game loop, and poor people in the third world to go through this game loop in order to earn tokens. I don't think that this is a good idea. I don't think this is good for the world. I don't think it's good. I don't think it creates value. I think it's basically it's mostly kind of nonsensical, and sort of a kind of a shell game. But I do think that there are going to be what is increasingly being called play and earn games. And I think in these play and earn games, which, I actually had a tweet a little while back that said, the original play to earn game is poker. And I think poker is probably actually the cleanest example of what play to earn can look like when it's healthy, which is that some people make money, some people lose money, and some people make no money at all. And that obviously is the only way an economy can work. There is no economy where everyone makes money. That's a perpetual motion machine. That's nonsensical. It has to be the case that if some people are making money, some people are losing money, but that can happen in a healthy way. That can happen in a way that is kind of productive, and everyone's having a good time, and it actually creates a vibrant economy. Poker is a good example of that. And I think there are others, but it's going to look a little bit more complex than what you see today in games like Axie Infinity and other play to earn games that seem to be dominating most of the headlines. I think the sustainability in those are quite low. So we've made some bets in games that we think are likely to find some success in the long run through that type of more fully fledged approach to gaming. The other thing, of course, that building a great game, it has to be fun first. The fun has to come before the earning part. And that, I think most of the games in crypto today have kind of flipped it around, where if you look up content on any of the play to earn games that exist today, you can't find anything about playing the game. Everything you'll find is about making money, which is a sign that okay, it's not really about the game, it's about making money. And I think there will be a point where NFTs and gaming and crypto are going to intersect in a really big way. But it's going to be more about how fun it is to be a part of this world, because, poker is a great example of how money can make a game more fun, not less fun. But mostly right now, the games that exist today, the monetary aspect of the games is making them less fun, not more fun.
Yeah, I also feel with gaming, the random elements within game, that's where the joy comes in. So let's say if we focus on play to joy, right? If we're just playing for the heck of it just to earn, that joy elements dies out, and then the network effect, when it's a one particular game, might not carry forward for a long period of time. So I think I'm in agreement with you. So Haseeb, shifting gears a bit more. You mentioned XLR as one of the plays in your infrastructure vertical. It's a cross-chain interoperability play similar to Layer Zero. So that is something we market at the moment. The public market does not have the liberty to kind of play because the tokens are not out there. So what are some of the similar kind of plays and narratives you're seeing in the private market that investors in the public markets are not aware of? And let's say in a few years, let's say we are sitting in 2025, that narrative might catch on. And if we are able to discuss that narrative right now, some of our audience can perhaps take advantage of.
Okay, that's an interesting question. Whew. Yeah, it's really hard to know what are the important narratives that are going to be at play in the future. I mean, one of the things that I would bet is probably at least 2 to 3 years away, if not possibly longer, is privacy, is on-chain privacy. Right now, if you look at on-chain privacy, so I've actually been somewhat of a bear on privacy, and I recently published a piece on CoinDesk as well as on our own research blog talking about why I'm bearish on privacy. But there are some private solutions. I mean, one thing that's very clear is that DeFi at scale in the future, 20 years from now, DeFi is not going to be the way it is today, which is that everyone can see what everyone else is doing, right? There may be there's a lot of value to having the overall picture of DeFi be verifiable in aggregate, but knowing exactly who is doing what and being able to front run individual traders and also, just kind of track their flows of money on chain, that is clearly not going to be the experience that we're going to be doing 20 years from now. So the question is, how does that change? And right now, it's one of the questions that really almost nobody is taking seriously because it's so hard. it's such an incredibly hard problem, and there's so many other proximate things we need to solve first, right? Scalability and UX and cross chain and blah blah blah. But there are some people who are working on this problem. So one example is a project called Alio. It was founded by this guy Howard Wu, who used to be at Berkeley, and I think they recently ended up raising a round from SoftBank, and they're planning to launch, I think, sometime in the next year. And another project that we backed is one called Penumbra. So it's founded by this guy Henry de Valence, he was a researcher at Zcash, and he's building basically a private smart contract chain that can allow you to interact with DeFi, particularly something like Uniswap v3 or Uniswap v2, entirely in private. So obviously, in order to use something like Uniswap, you have to be able to see the order book. You have to be able to see who's trading, sort of what the price is, what the unit price is at any given time. But you don't need to be able to see who is executing what order. And so you can build this kind of thing in complete privacy. And you can also get the staking to be done, such that the validator set is also completely private. And so, building this stuff is extremely hard. There's a lot of kind of greenfield problems that need to get solved in order for this to be possible. But it is clearly one of the important problems that will get solved at some point in the future. And so, who knows if it's going to be this generation of products that are going to be the one that actually end up shipping solutions. And none of them are live yet, because to actually solve this, it just takes a lot of R&D work. So most of the things that you see that are in the private markets, in the public markets today, they're usually things that can ship quickly, because then they can launch the token fast. And, so if you're going to build like some marginal improvement on some DeFi, I'm going to do isolated borrowing and lending on, Avalanche, right? That's the idea. It's like, okay, well, people already built that on Ethereum, so it's a solved problem. People know how to build it. You just take that, you fork it, you launch it on Avalanche, you get a new audit, and then boom, you're in business. Now it's time to, let retail buy your token. But if you're trying to, usually the most valuable things are the most value that's created is by solving hard problems. And hard problems really require a lot of time, a lot of R&D, a lot of hard work, and they usually require a lot of capital. And it takes a while before those things can go live and before the tokens can even exist. But almost everything that you see, if you look at the top 20 on CoinMarketCap, almost all of those things, these really, really great investments, historically in crypto, none of them were quick token launches. They all solved really hard problems and required a lot of capital. So you look at, things like Solana or Avalanche or even Uniswap. They took a really, really long time to build because they were solving the problem for the very first time. And they were also the ones who captured the lion's share of the value. And I think this is a general pattern to observe in crypto. Oftentimes in crypto, it's perceived that, what VCs do and the way to really make a lot of money is to, flip these projects really quickly. You invest, in the seed, and then by the Series A, the token's live, and then you dump it on retail. There are some people who make money doing that. It's not the kind of thing that we do, but it's also not where you make the real returns. You can do okay doing that kind of scalping retail over and over again. But the real returns come from actually solving hard problems. And that takes time. And I think privacy is one example of that it's going to take time for this problem to get solved in a way that both the fundamental technology problems get solved and the UX and the usability problems get solved. That's going to take time. But the pie that we're fighting for is going to be really large, because almost certainly in 20 years, nobody's going to be using blockchains of the architectures that we have today, where everything is transparent and everyone can track what you're doing. We're going to have some kind of hybrid between what we have today and complete unobservability. And I think that's going to be coming from most likely this generation or the next generation of entrepreneurs who are trying to solve this problem.
If I recall, there are a few L1s which are trying to tackle the privacy issue. I think Secret Network in Cosmos, and also Oasis.
That's right.
Yeah. So do you reckon, let's say, if an investor want to play that theme, could that be a better way to play that, because they also have that smart contract functionality relative to, let's say, some other project, let's say Zcash or Monero, which doesn't provide you that smart contract capability, for example?
That's right. So Secret Network and Oasis are both currently live, and there are ways that, in public markets, you can take a bet on the privacy narrative beyond just Zcash or Monero, which are the two leading privacy coins themselves. And then, of course, there's, projects like Tornado Cash, which also have a token that you can invest in. For Oasis and for Secret Network, they both are private via their use of Intel SGX. So Intel SGX is this sort of trusted hardware. And by using trusted hardware, if you trust the underlying guarantees that are made for you by trusted hardware, then you can trust basically that the hardware is ensuring the the integrity and the confidentiality of the information that's being computed upon inside of the secure enclave. Right? That's the idea of what Intel SGX and some of these other trusted hardware primitives can do. So while Intel SGX is, I think, a very promising piece of hardware, a lot of people, I think, in the long run, are hoping for an approach to security and privacy that doesn't require trust on Intel, effectively. And so I think Oasis is exploring mechanisms by which they can end up moving beyond the reliance on Intel SGX. And I don't know as much about Secure Networks' overall roadmap, but right now they're completely reliant on Intel SGX. But I do think in the long run, cryptography is going to be the eventual approach that we're going to be taking. I don't believe that in 20 years from now, it's going to be that, okay, we trust Intel and their secure hardware. That's how we're going to end up having, securing all of the world's wealth and all the value that's going to be secured by smart contracts are going to be ultimately protected by Intel. I think trusted hardware is a great bootstrapping mechanism to get security and privacy and confidentiality. But in the long run, you have to have first principle solutions that can scale beyond the security model of a particular company.
So those first principle components could be, let's say, ZK technology. Is that where we're heading?
Exactly. That's just one example of how you can get there.
So Haseeb, we discussed a lot about your thesis, some of the winners you had. Just to be cognizant of the time, I would also like to explore some of the losers in your portfolio, and either professionally or personally. And what were some of the lessons you learned? And now, when I say about losers, it could be either a deal missed, or it could be something you invested in, and the way you thought about the world, or maybe the way you thought about the project just didn't play out. So for me, the most important element is what are the lessons you learned, and you can share it with our audience, and maybe they can also replicate that.
Yeah. So I'd say, pretty clearly the biggest miss that I made in my career, the one that probably haunts me the most, is passing on the Series A of Uniswap. And so, at that time, this was back before DeFi summer that the Series A of Uniswap was going around. And Hayden, the founder of Uniswap, he really liked us. He knew who we were. He was fans of our writing and our research, and he really wanted us in the round. And so he ended up pitching us. And this was, this time we ended up doing a bunch of work on Uniswap, trying to understand, how Uniswap was doing. And of course, we were aware of the product before Hayden had pitched us. And, the reason why we passed on the Uniswap investment was, a bunch of analysis that we'd done that we didn't think that Uniswap was going to work. So for one, we thought that, so most of the Uniswap pools were actually not profitable. 6 out of the top 10 pools we'd done an analysis were not profitable since inception, meaning LPs had lost money because of impermanent loss. Second, is that most of the top 10 pools were basically shitcoins. And in fact, I think 3 of them were incentivized pools, right? So there was the Ampleforth Geyser, which basically, the only reason why that was there was that Ampleforth was paying them. Same thing with the SUSD, the SUSD to USD pair was, I think it was SETH to ETH, from Synthetics, was only there because it was being incentivized by synthetic stakers. And then there was Hex, and Hex was by far the largest pool. And Hex, I don't know if you know, it's basically a Ponzi scheme. And so we were just like, okay, look, either it's shitcoins, or basically it's, things that are unsustainable because they're being paid, to have their LP positions there. And that doesn't seem sustainable. And then lastly, the final reason why we passed is that we thought the protocol didn't have a moat. We thought it was very forkable. And we thought there was a real risk that this thing was going to get forked, and that that this was going to be a big catastrophe for the protocol, and that there weren't necessarily network effects across the pools that were going to protect it from forking. And that was the reason why we passed. And it turned out we were right about everything that we said, and it didn't matter. So we were right that it was a bunch of shitcoins. Till today, a huge amount of the Uniswap volume is shitcoins. It doesn't matter. It turns out there's a lot of demand for shitcoins. Second is that the idea that, like, okay, this thing is only profitable for LPs net of incentives, because the incentives are producing a huge amount. When we were analyzing all these pools that weren't profitable, still today it's called liquidity mining. And of course, liquidity mining back then was tiny. Nobody really understood liquidity mining until Compound launched its liquidity mining program, and liquidity mining took off as a broader phenomenon that people could really start to wrap their heads around. But back then, the first people to do liquidity mining were Synthetics and Ampleforth. And we didn't really understand it. It just looked like they're compensating these people in a way that's unsustainable, and that isn't a long-term strategy. It turns out that was the strategy for Uniswap. That's why Uniswap became so successful, was because liquidity mining was so easy to do via Uniswap. And third, yeah, we were right. Uniswap got forked, and it didn't matter. Uniswap was still by far the most dominant protocol in DeFi. And so it turns out, although we were right on every point of our analysis, we missed the bigger story. And the bigger story was that Uniswap was fundamentally new. Uniswap changed the rules of the game. And that was a big, big, big lesson for me. And I remember, when we saw, the day that Uniswap token went live, and the thing went up from, $1 to $7 at, I think it was 7 billion fully diluted by the end of the night. And I think the Series A was at like 100 million or something like that. And so it would have been like a 70x at that price, and of course even larger now. It was a real come to Jesus moment for me, and sort of making me realize how easy it is to be overconfident in your analysis of and missing the forest for the trees. And again, this notion of not investing for lack of weakness, but investing for strength. The thing about Uniswap that made it so unique was that it's a fundamentally new way to bootstrap liquidity and to create new ways to trade in DeFi permissionlessly, and to do so much easier and lower upfront investment than any other form of trading in DeFi. And we just didn't appreciate that. At the time, Uniswap wasn't even the highest volume trading mechanism on chain. I think it was a Kyber at that time. It was doing more volume than Uniswap was. But Uniswap in the end ended up being the winner, and we totally missed it. So that was a big lesson for us.
Right. Apart from Uniswap, any other deals? I know there have been many deals that this is a part and parcel of being a venture capitalist. All right. Just to be cognizant of time, I think let's conclude the podcast. But before we conclude, let's say if there is an investment analyst or a venture analyst starting in crypto, maybe mid-20s, similar to my age. So what career advice would you give him or her in terms of being a good investor or just having a good career who are starting now in crypto?
Career advice. So the first thing I would say is, if you want to be a great investor, there are 3 things that you need in order to be a great investor. So 1 is you need great judgment. 2 is you need a great network. And 3 is you need great deal flow, right? Those are the 3 things you need. So in order to build a great network, so the first thing is like, if you're very early in your career, find some way to get in front of everyone important in the industry. That's step 1. If you get in front of everyone important in the industry, you will build a network. And that network will be instrumental to you being able to get things done and accomplish things through your career as an investor. So the second is judgment. How do you have great judgment? Getting great judgment comes from being very, very deep and really deeply understanding something. Now, you're inclined or you're tempted as an investor to try to be an expert on everything. And I think that's a fool's errand, especially in something like crypto that's grown so dramatically. It's impossible for any one person to be an expert on everything. I'm not an expert on everything. So the one thing that I strongly recommend to people who are trying to become great investors is specialize. Find some niche or some particular area where you are going to be world-class. You are going to be better than almost anybody else in that particular field. Right in that field, get connected to the most important people in that field. Be part of every important conversation in that field, but get it as narrow and tight as you can, so that you actually have a shot to be one of the 10 most knowledgeable people in the world about that particular sub area. And then third is deal flow. How do you end up getting great deal flow? The answer is that you want to know everything important that's going on, right? You want to know every important deal and every important investment. And so how do you figure that out from first principles? I think the answer is very simple, is that, look back at all the fundraising announcements of the deals in the area that you want to generate your deal flow in, and look who is in. And now when you look who's in, you're going to see a lot of the same funds. It's a lot of the usual suspects, folks like Andreessen or Paradigm or us or Polychain or whoever. But the other thing you're going to see is you're going to see a lot of other random people, right? You're going to see like, oh, this individual person or this like tiny little fund that no one's heard of or this like little thing. Go make friends with those people. It's hard to make friends with Andreessen. Andreessen's not going to send you deals. But all these little guys along the way, like the angels, the influencers, the small funds that end up getting into these deals, go get to know all of them. Go reach out to them, build relationships with them, find ways to be valuable to them, and make friends with them, and find be accretive to those people. And that's how you're going to end up finding your way into these great deals, building your brand. Brand is the hardest thing to build, right? Brand is the thing number 4 that really, really matters in order to become a great investor. But brand is one of these things that you can't get brand directly. You get brand by doing all these other things really well, right? You get brand by all these really important people knowing you and being in the flow of things and getting great deal flow and having great insights and publishing great things and being valuable to other people. That's how your brand grows. But you get brand by doing all these other things well within your overall network and assets as an investor. So that would be my advice to somebody who's starting at the beginning of their career.
Thank you, Haseeb. That was a very good advice, and it was pleasure having you on 100x.
Thank you. It was a pleasure to be here. Great chatting with you.